can go across to Manpreet Gill. He's the Chief Investment Officer, Africa, Middle East and Europe at Standard Chartered Bank, who's joining us this morning. Manpreet, hi, good to be speaking with you. Thanks so much for making time for us. Just wanted to begin by understanding from you as to what the global investment climate is looking like after Trump 2.0. It was that Trump trade of dollar strengthening, US yields going up and money flowing back to the US. Do you expect that to continue at least for another couple of months, or do you see it unwinding a bit as we head into the later half of December?
Hi, good morning. I think it depends where you look, because I think at the moment we're still in the midst of that Trump trade. If you look at the US dollar, we've had a lot of strength. And when you think about some of the topics you talked about, Asian equity markets in particular, that's still putting some downward pressure. Stronger dollar is negative in terms of foreign investor flows and emerging market equities. I think where we start to see a little bit of softening, of course, is in terms of bond yields. We had this initial fear that Trump's policies would be singularly inflationary, and Scott Bessent's appointment, of course, has mitigated those fears to some extent. So that's the good news. But undoubtedly, there is still a lot of focus on what Trump's proposed tariff policy, America First policy, what does all of that mean for emerging markets? And I think that's keeping the dollar elevated.
Right. A very good morning to you, Manpreet. The Sherlock are joining in the conversation. And let's talk about what exactly is happening today when you talk about yen, because you've seen a sharp rally that's come about in yen when you compare it to the dollar index. Also, one of the reasons or crucial reasons being that the inflation data has come in much higher than expected. They are expecting the BOJ to go ahead and hike rates this time around. At least 60% of traders are betting on a rate hike to come in for the Bank of Japan. While on the other hand, we're all awaiting what the Fed is also going to do, and that's the reason why we saw also the tech stocks also move the way they did day for yesterday. What's your take on this? How should one actually view the way how the central bankers are going to move globally?
Well, I think the Bank of Japan is a bit of an exception here because it's perhaps the only standalone story amongst major economies today. It still has very, very low rates, and arguably, at least we've always been of the view that if you look at labor market wage growth data, Japan's economy does appear to be turning the corner in terms of generating some inflation. Now, that's good for growth, but it argues for higher central bank rates. And in our view, at least, we'll continue to see this. It's a balancing act because the BOJ clearly doesn't want to unbalance markets too much. But eventually, we think it will mean higher yields and potentially a stronger yen. So that's, we think, a long-term trend, not a straight line one, but one when we take a full year view, we'll move in that direction of. Elsewhere, it's really a question of how much central banks ease. In our view, the Fed will continue to ease. December, perhaps an easier one. It allows room for the Fed. Real rates are very high, so the Fed can cut rates by 25 basis points. Next year, perhaps a slower pace of rate cuts. Something in the line of quarterly might be more likely, because on one hand, we still think they're required to support growth in the old soft landing environment. But if fiscal policy turns more stimulative, deregulatory policies are more supportive for growth, but all the policies are a bit more inflationary on the margin, then perhaps the Fed needs to cut at a slightly lower pace. So I think central bankers, a lot of them also just waiting to see what does Trump's policy platform mean in reality once the new administration takes charge in January from an inflationary perspective. So I think the US particularly, I think, is going to be quite focused on that from a central bank perspective.
Interesting. So January 20th is that date when he kind of, gets on board. So we'll watch out for that. But Manpreet, at this point of time, what's the best tactical trade globally? Because of course you look at, you look at Africa, Europe, Asia, and all of that. Tell me what's the best tactical trade across asset classes, across geographies?
Well, I'm going to cheat a little bit and take two, actually. I think number one would still be equities, particularly in the US. I think that the sum total of a lot of what we've been reading about Trump's proposed policies is that they're good for continued outperformance of US assets. So we've always been overweight US equities relative to other major regions. And we think this policy platform does allow room for that to extend. So that, in our view, would still be one area. And we can debate sectors within that. Technology, we like financials as well, but I think it's the big picture of US outperformance relative to the rest. The other one still for me would be to, in major economies, major currencies, at least to lock in bond yields while the opportunity is still there. Because you can debate how much bond yields and interest rates might fall, faster pace or slow pace, depending on the inflationary outlook as we discussed. But one way or another, cash yields are falling. And that's coming after a couple of years where they were unusually high. And we think there's a narrow but rapidly narrowing window to lock in those yields for as long as possible through bond markets. So I think those are the two we'd really be very focused on at this point in time from a global markets perspective.
Right. So those are the sectors that one should watch out for. A quick view I wanted to take on the dollar index. One of the major factors that everyone is watching out for, even when you talk about the Indian markets, dollar index also is very crucial because you saw it actually see an elevation to around 108 levels. It did cool off a tad bit. But how are you viewing this sort of a move coming in the dollar index and what it exactly means for the emerging markets?
You're right. I think from a foreign investor flow perspective in India, the dollar is perhaps one of the single most important variable still. Look, undoubtedly in the very short term, the pressure is clearly to the upside. We were in sort of this 100 to 106 range on the dollar index for almost 2 years, but we've broken a little bit above that. And I think some of that really coming from tariff policy, some of it coming from higher bond yields. Now, the bond yields pressure from bond yields appears to be cooling a little bit. We do think the dollar, will soften from these levels, perhaps more gradually than bond yields. Perhaps it'll require, statement of actual policy intent from a new U.S. government. But we think that that softening, of course, will be moderate. And I think tariffs are really the key because look, the interest rate picture perhaps a little more predictable. I think tariff policy is the one most investors wait to see what exact or precise form it takes. So I think for the dollar, look, directionally, perhaps we're past the worst of the downward pressure on EM equities and Indian equities. But we need some more now specifics from the US government to gauge just exactly how much it does soften. We've most probably just moved into a higher range. And I think these sort of one-off moves can have temporary downside impacts. For Indian equities, for example, we're still overweight because, look, this can have a temporary impact, but longer term, unless we're at the start of a new dollar rally, we still think the longer term growth fundamentals ultimately take hold. And amongst the emerging market space, we still think Indian equities offer the best visibility in terms of future growth and earnings.
Yeah, and that visibility is coming in at a bit of a premium, and that's what people are paying for India. Thanks, Manpreet, for making time and speaking with us this morning. So that's the latest on the global setup. But today, a lot more.
If you like this video, then like, share, and subscribe to ET Now.